Welcome to the Opening Bell Report.
Welcome, everyone. If you are joining us today, there is a very good chance you checked your portfolio this morning.
Or just glanced at the financial news and did a total double take.
Exactly. I mean, we are dedicating this entire deep dive to one burning question: why Block stock just exploded over 16% today.
It is wild.
And to be incredibly precise, based on the analysis report we are looking at today, we are talking about a 16.75% surge, breaking out to a price of $63.70 in a single trading session.
Right. It's really the undeniable financial event of the day.
Okay, let's unpack this. Our mission today is to decode Block's massive Q4 earnings blowout. We're going to look at the underlying numbers from the analysis report, the corporate strategy, and exactly why Wall Street is so aggressively upgrading this stock right now.
It's great to be here to dive into this with you. And what's fascinating here is, well, we need to immediately clarify what this price action actually represents.
Yeah, because it's easy to misinterpret.
Exactly. When you see a stock shoot up nearly 17% in a single afternoon, it is very easy to assume you are looking at some sort of retail-driven frenzy.
Like a meme stock pump, a flash in the pan.
Right. But looking at the institutional flows and the earnings data and the analysis report, this is the exact opposite. This was a textbook fundamental earnings blowout.
Completely fundamentally driven.
Yeah. What we are witnessing is Jack Dorsey and the executive team at Block officially signaling the death of their growth at all costs era.
They are done with that.
They've completely taken that old Silicon Valley playbook, thrown it out the window, and replaced it with a strict mandate for massive, scalable profit.
And that is exactly why we are bringing this to you today. Whether you are actively managing a stock portfolio or trying to figure out where the broader tech sector is heading.
Or you just enjoy understanding how massive corporations manage to pivot their entire strategy.
Right. This deep dive is going to give you some real clarity on how modern business momentum works. Block, which most of us originally knew as Square.
Yeah, a lot of people still call it Square.
They're putting on a masterclass in changing the market narrative. So let's start with the earnings blowout itself. I'm looking at the initial data from the analysis report for the quarter, and the profit jumps seem unusually high for a company of this size.
They really are.
Can you break down exactly what drove this surge today?
Absolutely. To understand why Wall Street reacted the way it did, we need to look at two specific staggering numbers. First, Block's gross profit jumped 24% year over year.
24%.
Yeah, they hit $2.87 billion for the quarter. But the metric that really set the market on fire was their operating income. That skyrocketed by 46%.
Wow.
Hitting $588 million.
Just so we're all on the same page here, we hear terms like gross profit and operating income thrown around constantly in financial news.
All the time.
Could we quickly delineate those for you, the listener? Why does a jump in one matter more than the other?
It's a great question because the distinction is everything here. Gross profit is essentially your revenue minus the direct costs of delivering your product or service.
Right. It's a measure of basic viability.
Exactly. But operating income is the real test of corporate discipline. That is what is left over after you pay all the salaries, the marketing budgets, the corporate leases.
The server costs, research and development.
All of it. So when a company's gross profit goes up 24%, but their operating income goes up 46%, it tells you a very specific story.
They aren't just selling more products.
Right. They are running a significantly tighter ship.
That makes total sense. They're keeping more of every dollar that comes through the door. But to appreciate why the market is cheering this so loudly today, we probably need to rewind a bit.
We do.
Because Block wasn't always known for this kind of financial discipline, were they?
Not at all. And that historical context is crucial for anyone trying to understand today's price action. For years, Block was the ultimate pandemic darling.
Oh yeah, everyone was using their products when the world was locked down.
And the stock price reflected that. But then, as the macroeconomic environment shifted and interest rates started rising,
the stock suffered a brutal 80% drawdown.
Investors completely panicked.
Because money wasn't free anymore, right? The market looked at the company and just saw a massive cash burn.
Exactly. The market essentially said, look, we don't care how much revenue you're bringing in or how many new users you have if you are burning through mountains of cash to acquire them.
So the narrative around Block just became great products, terrible profitability.
That was the consensus.
So how do you turn around a ship that big? The analysis report highlights a pivot toward aggressive cost cuts and AI integration. But what does that actually look like in practice?
Did they just lay off a massive percentage of their workforce?
Right. Is it just headcount reduction?
Well, headcount reduction is part of it, which we have seen across the entire tech sector over the last 2 years. But the real shift is in operational efficiency.
The AI piece.
Yes. They are heavily integrating AI into their internal workflows, automating customer service, streamlining coding for their developers, improving risk modeling for loans.
So they can do more with less.
Exactly.
Yeah.
It means they can process more volume and launch new features without having to hire thousands of new employees to support that growth. And all of this discipline is driven by a laser focus on what is known in the software industry as the Rule of 40.
I want to pause right there.
Yeah.
Because the Rule of 40 is a term that gets tossed around a lot in elite financial circles.
It's the gold standard.
And it is so crucial to understanding Block's turnaround. Could you explain that concept in plain English? What does it actually mean when a company hits this threshold?
I would love to. The Rule of 40 is a principle used by investors to measure the health and sustainability of software and tech companies. The math is incredibly simple.
Okay.
You take the company's growth rate, usually revenue or gross profit growth, and you add their profit margin. If those two numbers combined equal 40% or more, the company is in an elite scalable tier.
So it's about balancing two conflicting goals.
Precisely. Think of it like evaluating a car. Growth is your top speed, and profit margin is your fuel efficiency.
Right. And usually, if you want to go incredibly fast, you are going to burn a massive amount of gas.
And if you want great gas mileage, you have to drive slower. Achieving the Rule of 40 means you have engineered an engine that can drive at top speed while still sipping fuel.
That's a great analogy.
Historically, Block was driving fast but burning gas at an unsustainable rate. Today's numbers from the analysis report prove they have completely re-engineered the engine.
That is a brilliant way to put it. And you really can't talk about that new, highly efficient engine without looking at the biggest piston driving it.
Cash App.
Exactly. Because while the overall companies saw a 24% gross profit jump, the analysis report makes it clear that one specific product is doing the heavy lifting. The absolute star player of this earnings report is Cash App.
Without a doubt. The numbers show that Cash App's gross profit surged an incredible 33% year over year.
33%.
It is the primary vehicle driving Block's entire valuation right now.
Here's where it gets really interesting. Because the way we culturally think about Cash App has fundamentally changed.
It really has.
For the longest time, what was Cash App to most people? It was just a casual, frictionless way to split a pizza bill with your friends. You owe someone $20 for drinks, you use Cash App.
Right, pure peer-to-peer.
But that is no longer the reality. Block is successfully transforming Cash App into a primary bank account. And they are specifically targeting and winning over millennials and Gen Z.
That shift from a casual peer-to-peer payment app to a primary financial hub is the defining success story of Block today.
But wait, I have to play devil's advocate here for a second. Are people really trusting a peer-to-peer app with your entire paycheck?
It's a valid question.
I mean, going from paying a friend back for concert tickets to routing your actual salary into an app feels like a massive leap of faith. How is Block actually convincing an entire generation to abandon Chase or Bank of America?
It does sound like a massive leap until you look at the friction of traditional banking for a younger demographic. Gen Z largely detests walking into a physical bank branch.
They hate it.
They hate maintenance fees, overdraft fees, and clunky legacy banking apps. Block stepped in and offered a beautiful, seamless user interface.
And they introduced the Cash Card.
Yes, which acts just like a debit card. They offered early access to direct deposits. They integrated Bitcoin purchases and fractional stock investing directly into the same app where you text your friends money.
So they just removed the friction completely?
They removed all of it.
Okay, so the user experience is better, but how does that translate to the bottom line?
There is a specific critical metric from the analysis report that explains exactly why this strategy is printing money. When a user treats Cash App like their primary bank, meaning they are getting direct deposits, swiping the Cash App card for groceries, managing their savings there,
Right.
they generate roughly 10 times the gross profit of a standard peer-to-peer user.
10 times. Let that sink in for a second. If you just send your roommate money for utilities, Block makes a tiny fraction compared to when you decide to route your actual paycheck through their system.
Exactly, because when you use it as a bank, they are collecting interchange fees every time you swipe the card. They are collecting fees on instant transfers. They are monetizing your cash balances.
The compounding effect is huge.
If we connect this to the bigger picture, you can see the genius of what Jack Dorsey and the team have built. By locking young users into this comprehensive financial ecosystem, they are drastically increasing the lifetime value of every single customer.
It's like Apple's ecosystem strategy.
Yes, but applied to personal finance. It is not just about acquiring users anymore. It is about deepening the monetization of the users they already have.
Which naturally brings us to the legacy players. Because if Block is capturing all these young users and building this walled garden, we have to talk about the companies losing that market share.
The old guard.
Right. To truly put this massive 16% rally into perspective, you have to look at Block's biggest legacy rival, in the digital payment space. PayPal.
This is one of the most compelling narratives in the market right now. We have a fascinating valuation puzzle on our hands.
Yeah, the analysis report really highlights this.
Currently, based on the metrics, PayPal is trading at a significantly cheaper PE ratio. That is the price-to-earnings ratio. Right now, PayPal is trading at a multiple of around 8 times.
Okay.
Meanwhile, Block is hovering around a multiple of 10.6 times.
Okay, let's break that down for anyone who doesn't stare at stock charts all day. The PE ratio is essentially how much investors are willing to pay today for $1 of the company's earnings.
Precisely. Think of it as a price tag for the company's profits. An 8x multiple means you are paying $8 for every $1 of earnings. So on paper, PayPal is the cheaper stock to buy.
So this is the paradox. If PayPal is trading at an 8x multiple and Block is trading at a 10.6x multiple, why is Wall Street aggressively buying the more expensive stock?
It seems counterintuitive.
Why are institutional investors throwing billions of dollars at Block and pushing the price up nearly 17% while passing over a massive established brand like PayPal?
The answer comes down to one word: momentum.
Momentum.
Yes, PayPal is cheaper on paper. But you have to look at the health of their core business. The analysis report notes that PayPal's core branded checkout, the actual PayPal button you see when you buy something online,
Right.
it grew by a dismal 1%.
1%. When you adjust for inflation or just the natural growth of e-commerce as a whole, a 1% growth rate is essentially going backwards.
It is absolute stagnation. Furthermore, PayPal's forward guidance, their own internal projections for the future, is completely flat.
Wow.
PayPal is undeniably a massive cash cow. They generate a staggering amount of free cash flow, but it is a giant ship that has stopped moving forward. They are a button on a checkout page, whereas Block is building a closed-loop financial universe.
And investors absolutely hate stagnation. They don't just want cheap stocks, they want growth. And more importantly, as we just discussed with the Rule of 40, they want growth combined with expanding margins.
That is the crucial difference. Block is not stalling, they are accelerating. They are actively eating market share directly away from legacy players.
So while you might pay a slightly higher premium for Block today with that 10.6x multiple, you are buying a company that is rapidly expanding its gross profit,
Expanding its operating income.
and locking in the next generation of banking customers. They are essentially stealing the fintech crown in real time.
It is incredible to watch that changing of the guard.
Which brings us to the question I know is on your mind right now. You are listening to this, you are seeing a price of $63.70 on your screen, and you are asking the burning question, is the train already gone?
Is it too late to buy after a 16% pop? It is the most natural question to ask after any massive single-day rally. To answer it impartially, we have to look directly at the company's forward guidance in the analysis report.
What are they projecting?
Well, management didn't just report a great quarter and take a victory lap. They significantly raised their forecasts for the future. They just raised their 2026 adjusted operating income guidance to an astonishing $3.2 billion.
$3.2 billion. Just to put that in context, the data notes that this represents a massive 54% year-over-year growth projection.
It's huge.
That is a wildly confident signal to send to the market. They are planting a flag 2 years in the future and saying, we are going to grow our operational profits by over 50%.
And Wall Street analysts are forced to update their spreadsheets based on that new reality. Because of this heavily raised guidance, analyst price targets are being rapidly revised upward right across the board.
What's the new target?
The current consensus among analysts is pushing toward a target range of $84 to $89.
Let's do the math on that for you. If the stock just broke out to around $64 today, and the new consensus target is pushing toward that $84 to $89 range.
That target range represents another 35% to 40% upside from today's breakout price.
That is significant.
So, to answer the question of whether the run is over, the institutional consensus seems to believe there is still significant runway left. To summarize this entire forward outlook, Block has successfully flipped the switch.
They really have.
They went from a company known for burning cash to a company generating massive free cash flow, and the market is finally rewarding them for that discipline.
So what does this all mean? If we distill this entire deep dive down all the multiples, the 33% cash app growth, the 46% operating income spike, what is the core takeaway for you today?
It's all about profitability.
It is this. The era of a tech company simply promising future growth to investors is completely over. The market no longer cares about a cool product or massive user acquisition if the core business bleeds money.
Right. The market now demands scalable profit.
You have to prove that your business model works efficiently at scale. And based on the numbers we explored today from the analysis report, Block is the new gold standard for that exact pivot. They showed the world how to transition from a growth-at-all-costs pandemic darling to a lean, highly profitable machine.
This raises an important question for anyone evaluating companies in today's market. You really have to understand the difference between a stalling legacy cash cow and an expanding modern ecosystem.
Like PayPal versus Block.
Exactly. PayPal is generating cash but stalling at 1% growth. Block is expanding, innovating, and capturing the next generation by solving their specific friction points. Understanding that dynamic, momentum versus stagnation is the ultimate key to evaluating tech and finance companies today.
You cannot just look at a PE ratio in a vacuum.
No, you have to look at the velocity and the direction of the ecosystem.
Exactly. And that brings me to a final provocative thought for you to chew on today. We talked heavily about how Cash App is locking in millennials and Gen Z by becoming their primary bank accounts.
Right, the 10x multiplier.
Not just a peer-to-peer app, but the actual destination for their direct deposits and daily spending. If apps like Cash App are successfully doing this and achieving that massive gross profit multiplier by doing so, what is the survival strategy for traditional brick-and-mortar banks over the next decade?
That is the trillion-dollar question.
If younger generations are entirely locked into digital ecosystems like blocks, where everything from buying Bitcoin to getting a paycheck happens on a smartphone screen, are we watching the slow, quiet extinction of the neighborhood bank branch in real time?
It is something to seriously think about as we watch these fintech giants take over.
We want to warmly thank you for joining us on this deep dive today. Exploring the mechanics behind a massive market move like this and getting past the headlines to understand the real strategy inside the analysis report is exactly why we do what we do.
Absolutely.
Keep an eye on those changing narratives. Watch out for the Rule of 40, and we will see you next time.
Don't forget to like, share, and subscribe for more.